Happy New Year and welcome to Investors Insights. We're excited to be with you today, and our topic is Overshadowing Omicron. We've got information for you in regards to the first vlog of 2022 and what we're looking at this week and on into the coming weeks and how your portfolio can be impacted. I'm joined by my colleagues Bobby Norman, Ty Miller, and Trey Booth, and we're looking forward to our discussion. And I also want to remind everyone, as I always do, that follow us on social media, on LinkedIn, Twitter, Facebook, our podcast. We're going to continue this dialogue throughout this week and on into the coming weeks. So with that, there's no doubt that Omicron is going to be a major topic. People are very concerned. Offices are asking employees to work remotely during this time period or extend it out maybe after January 15th. But with that, Bobby, you pointed out, and Trey and Ty, that despite Omicron and COVID last year, this economy, this market was still strong. So there are things we need to emphasize that can overcome Omicron.
Yeah, one of the consistent bright spots in the market and the economy last year was corporate America's ability to deliver expanding profit margins, even with inflation spiking, specifically with the rising cost of raw materials and also higher labor costs. And a common question we heard last year was, how is the market able to continue to go higher with all of the concerns around COVID, inflation, the uncertainty around the Fed, and corporate profits were a huge reason why the market was able to continue to go higher last year. As you can see in this chart, the net profit margin for companies in the S&P 500 for 2021 was higher than all years since 2011. And two concerns we have going into 2022 is continued inflationary pressure and a more aggressive Fed. So if companies can continue to drive this level of profit growth through pricing power, continued pent-up demand, and some help with supply chain issues, then we could continue to see the market strength. And it's a simple formula. Higher corporate profits leads to positive earnings reports, which in return, usually, not always, leads to market strength. So we're watching corporate profits carefully in 2022.
Very, very much so. And I thought your insight was very valuable in relation to portfolios. Our phones and our meetings have had the constant question, as you said, how can this market go higher? And with Omicron out there now is a major emphasis. And, we just want to address that in this vlog. And in addition to that, you brought up, Trey, about the Fed.
That's right.
People are focused on Omicron, which is very serious. One area they may want to focus on is the Fed in relation to interest rates go higher. And that also brings up the point that the reason they're looking for interest rates to go higher is because the economy has been so strong.
That's absolutely right, Greg. The Federal Reserve has been a great tailwind for the markets and the economy, kept interest rates at near zero, and also provided stimulus by buying $120 billion worth of bonds a month. The Fed has already reduced their bond buying in January. They'll be buying $60 billion worth of bonds. Now, that's still a very large number, especially when you annualize it. But at this rate, they're expected to stop their bond purchases somewhere late winter, early spring. So in the next few months, we'll get to see what the market does without that Fed tailwind. Then the next step is rising rates. So, and the reason why that's very important is traditionally economic expansions don't die of old age. Before COVID, Australia had a 26-year unstopped expansion. So the economy can grow unabated. And like I said, it's typically not stopped due to length. It's usually killed by the Federal Reserve. The Fed has a terrible track record of taking off stimulus. Between 1955 and 2009, the Fed entered into 14 rate hiking cycles. In 11 of those, they had to reverse course because unemployment spiked and we went into a recession. So there are only 3 times between 1955 and 2009 where the Fed timed things right. That sounds very dire. In 2018, the Fed raised rates and the market had the worst fourth quarter since the Great Recession. However, we did not enter into recession. And that's because Jerome Powell saw the market trading down and reversed course before the economy weakened. So that should give us some strength, knowing that the individual that has been renominated to chair the Fed was one of the very few Fed chair people to have properly orchestrated a rate hiking cycle without pushing us into recession. So that could give us some strength. Now, we have a lot of new Fed nominees coming onto the board, so there's still some uncertainty. But if tradition holds, we may see a rocky 2022, 2023. However, if Jerome Powell is able to replay what he did in 2018, 2019, we could see a smooth transition thanks to higher corporate profits.
Right. And in previous vlogs, we talked about the importance of him being renewed as chairman of the Fed. That's very important to the markets. The consistency of the message, knowing who they're dealing with as Fed chairperson, that's very important to the markets. So we're going to continue keeping everybody updated as to the Fed dynamics and what we see down the road. With that, Ty, we've got some reports coming out, and as clients continue to ask about the impact of Omicron, I think we got a report this week that could give us some insight. Is that correct?
Yeah, and to build off Trey's point, one thing that Fed Chair Jerome Powell has done is pay attention to the job market, and that's one of the few things that's been different about him compared to other Fed chairs in the past. And with that being said, we have maybe the most important piece of economic data that we get each month, other than the COVID positivity rate right now, and that's the job report. Comes out on Friday. It'll reflect the month of December, which basically will entail the entire month of Omicron. In November, we had an unemployment rate of 4.2%. But with that being said, we added only 210,000 new jobs compared to an estimate of 550,000. So this would be an interesting report to see how that unemployment rate stands out compared to the labor participation rate.
Yeah, and should give insight to the Fed as to how they move forward. You agree with that?
Oh, absolutely. Jerome Powell will pay close attention.
With that said, we're excited about 2022 and know that we're, as always, available for questions and conversations, portfolio updates, financial blueprint updates as we go into this year. And we will keep you updated in the coming weeks. Take care. Have a great week.